Ladies and gentlemen, thank you for taking the opportunity to click through and to watch this recording. My name's Michael Durbridge. I'm joined here with Ben Heaney, and we are the directors of Regroup Solutions. We've put this recording together off the back of a presentation Ben and I ran at the Southport Yacht Club last week in the early part of November. And the feedback that we had from the presentation that was very well received. The information was very good, useful, and we thought we would take the opportunity to make this recording and share it out with our wider audience. Now, as with all presentations, here is our customary disclaimer. Ben and I put a lot of time and effort into preparing for this presentation, but we take no responsibility for how this information may be used. The topics that we're going to cover in this presentation are the changes to the ATO debt recovery actions that we've seen throughout the course of this year. We'll talk to business and company viability assessments and the importance of undertaking those assessments in the current environment. We'll also talk about some of the misconceptions that we see with the director penalty regime, and we shall also run through a couple of small business restructuring files so that you can see what a great process that has worked out to be. First things first, though, a little bit about ourselves. At Regroup Solutions, our core service is assisting businesses and company directors that are facing some form of financial hurdle or issue. Our focus is to help people get back on their feet financially and to regroup. Our solutions range from things such as informal workouts and negotiations, safe harbour engagements and protection for directors, recapitalisation, restructuring and insolvency management. It's been 5 years now since I first joined Ben at Regroup Solutions, and it has been fascinating to see how the marketplace has evolved over that period. We have seen increased regulation in many areas with the creation of a specific ASIC licence for debt management, the creation of director identification numbers, the inclusion of GST in the director penalty regime, and safe harbour protection for directors, just to name a few. Something that does come up time and time again is the advisor conflict issue. The intermingled connectors between the director personally and the companies that they control do mean that there's a wide variety of issues that do need to be contended with for the director. And insolvency practitioners can only go so far in advising a director, otherwise their advice may conflict them from acting for creditors and taking on those appointments. Something that we are seeing in this environment is that because of the wide variety of connectors and contemplations for a director personally, the decision-making process of directors has actually become much slower. People really are taking their time to understand their options, the issues, and the implications of the various courses of action that are available to them.
Thanks for kicking off the discussion, Michael, and greetings to anyone that's watching this video. In the 15 years that I've been in the turnaround industry, the advisor conflict issue that Michael just pointed to is most certainly not well understood by company directors. As an analogy, if a director of a sick business yells out, "Is there a doctor in the house?" what type of doctor should answer that call, and has the director been able to locate the right doctor for the particular situation? So often the director requires the services of a turnaround practitioner, such as Regroup Solutions, as well as a liquidator. There is such a lengthy list of things that a director needs to turn their attention to that fall well outside the role of a liquidator. Now, this gets even more confusing for company directors that are trying to locate help online. A business rescue keyword search will actually turn up sponsored ads branded for turnaround and director solutions. However, these sites are owned by insolvency firms that are really just after liquidation appointments. It is our position that directors need 100% independent advice, and this advice can literally be the difference between keeping or losing the family home. So talking about keeping or losing the family home, let's move on to the recovery actions being employed by the ATO.
On the point of ATO recovery actions, it has been fascinating to witness the changes in market forces in the last 2.5 years. We went through a period of unprecedented stimulus with liquidity being pumped into the market. The ATO, they did very little in terms of debt recovery. However, at the moment, we are seeing a tightening of monetary policy and the ATO ramping up their recovery activity. Regarding the ATO and their recovery actions, I conceptualise it as a bit of a train ride, and we can see a train moving through different stations. Through 2020 and 2021, it was a bit like there were no conductors, few ticketing machines, and there was no one at the stations collecting payments. So many businesses were on this train, but they weren't really being compelled to pay. And this led to a huge spike in unpaid liabilities that have been well reported. 2022, however, that's become the year of the director penalty notice. In March of 2022, the ATO sent warning letters to some 50,000 businesses who had arrears with the ATO, and from July onwards, we have seen a dramatic increase in the number of director penalty notices being issued. Many of the informed and proactive directors have been able to get off this train at the DPN station. They've had good information, they've been on top of their correspondence, and they have either recapitalised or they've restructured with a solid plan. I expect, however, 2023 to become the year of the ATO winding up application and court liquidations once all of these director penalty notices have been issued. Certainly in the last 6 to 8 weeks, we have started seeing a few ATO winding up applications coming through, and we just expect that that will naturally continue to ramp up. Unfortunately, however, for these directors, they are going to find themselves in a situation where they may lose their business and also be left with a very large personal liability to the creditors of the company, including the ATO director penalty notices. These directors, they're still going to be on the train, but they won't have any control. Casting my mind even further ahead, I do anticipate that 2024 and 2025, they're going to become years of personal bankruptcies and personal insolvencies. Now, these bankruptcies, they're going to occur off the back of debts that were incurred throughout 2020 and 2021, where the director penalty notices were issued in 2022, the liquidations occur in 2023, and these directors, they're going to be on a 7 to 8 year train ride from when their companies first started falling behind until when the bankruptcies are ultimately discharged and the liabilities finalised. Now, that picture is not the rosiest story I've painted right there, but I really think it is the scenario that's playing out in front of our eyes at this very minute. And the question really is, when do these directors want to regroup, and in what form is that going to occur? We've worked with a number of business owners in the last couple of years who have been able to regroup before either receiving or the expiry of a DPN. These directors have been able to mitigate their risks to the highest extent possible by being proactive. In recent weeks, however, we have started to see referrals for business owners who have got expired director penalty notices. One instance, it involves a company with a debt exceeding $1 million, and the director penalty liability is more than $500,000. Now, in that particular circumstance, the conversation now has to extend to the bankruptcy ramifications for the director, where a couple of months ago, it would have been a conversation about quarantining the risk at the company level. In that circumstance, the company nor the director, they just don't have the money to pay those liabilities. Now, this client can still regroup. However, the ramifications at the personal level are going to be much higher.
So let's just pause for a minute and take a look at this train analogy slide. The very first thing that comes to my mind when I look at this is that we are turnaround practitioners and not graphic designers. And I'm sure you may have been thinking the same yourself. What it is that Michael and I are trying to say here is that if directors don't act, they get stuck on a journey and it becomes increasingly difficult the longer they leave it. The time to deal with company financial difficulty is at the first 2 stops. Leave it past that and it will be a personal liability issue as well. Let's take a minute to have a look at the bankruptcy stop number 4 in this train analogy. Directors in this current environment actually have something to lose, and that's because we've all got increased wealth in property holdings. So many directors that we consult with have substantial equity, in particular in the family homes. And a big focus for us in the current environment is to help them plan on discharging as much personal liability as possible through an intelligent and well-managed restructure. In this marketplace, it is very difficult to see a set of circumstances that make bankruptcy an appealing strategy off the back of a corporate strategy, which again is why in the current market we're trying to solve everything at the corporate level. Now, if we cast our mind back a decade, so let's say 2010 to 2013, there was a lot more bankruptcy work taking place, and that was because it made sense for company directors. And in those times, company directors did not have substantial equity in the family home. We found this usually due to a combination of the director already have unsuccessfully used the equity to prop up a failing business, coupled with the decline in house values off the back of the GFC. But what it did do is it made the equity calculation very marginal after taking into account selling and marketing expenses. So in that type of market a decade ago, bankruptcy was a pretty appealing course of action because a non-bankrupt spouse was able to negotiate a deal with the trustee in bankruptcy to purchase the equity that may have resided in the bankrupt share for a nominal amount, which allowed them to keep the property. So bankruptcy in that market was appealing because it would bring finality to personal connectors to a corporate issue, including the types of claims that a liquidator may bring against a director, such as recovery of loan accounts and insolvent trading.
Yeah, back in those days, we didn't see liquidators following through on too many insolvent trading claims.
No, and it was exactly the same set of circumstances. Back in those days, there was a lack of equity or recoverable assets in a bankruptcy scenario. So what that meant was it was not commercial for liquidators to pursue those sort of claims. Now, this certainly is not the case in the current market. Again, many directors have recoverable assets. So as a result, we're seeing far more insolvent trading claims being raised and pursued against company directors than we did 10 years ago. So this is another very good reason why it is important for directors to get proper guidance in a landscape that does change quite a lot over time. And the starting point here is really to get good information in the director's hands so that they can be confident to act and get off this train line at the first available stop. Directors should not be waiting for a DPN, a stat demand, or a winding up notice before taking action. That's Schoolyard Common Sense 101. The warning signs exist long before any of these events come to pass. Those who do act on warning signs are going to get a far better outcome. And we've certainly helped many businesses get off this train line and return to profit without the directors losing their personal assets. So we know that small business owners have a lot on their plate. We know they wear many hats. Some business owners are so busy that they just focus on cash at bank. If they've got cash at bank, they're going okay. And if they don't have enough cash at bank, well, they're not going okay. Now, as we know, there's a little bit more to it than that. So the question is, what should a company director in financial difficulty be looking at?
We've always advocated getting decision quality information in the hands of directors so they can make informed decisions. This is where a business viability assessment and a company viability assessment are required. These assessments are uniquely different. For those of you who may have attended our presentations previously, something I do like to talk about is the quick ratio and measuring working capital deficiency of a company as a starting point in assessing options. Now, I usually do that in the context of our space being small to medium businesses. However, in preparing for this presentation, I got thinking about the big end of town. You might have remembered Virgin Australia Holdings. So Virgin Australia, back at the start of 2020, they appointed voluntary administrators to their company. Now, on the screen here are the quick ratio calculations and the working capital calculations we did on the Virgin financial statements from 2017 through to 2019. Now, what this data tells us is that back in 2017, the quick ratio was at 0.7 and the working capital deficiency was 706 million. By 2019, the quick ratio was down to 0.59 and the working capital deficiency was out to $1.3 billion. Now, Virgin had a balance sheet with billions of dollars of assets and liabilities. However, when we break these numbers down to a ratio, it does look remarkably similar to what we see in small business. Interestingly, in the Virgin VA, the cause for it was largely blamed by the onset of COVID in early 2020. However, there are about $2 billion worth of unsecured bondholders that only received 9 to 13 cents in the dollar. Now, those bondholders may well have been sceptical that all the damage was done in the first couple of months of 2020. I would contend that there were warning signs on the balance sheet long prior to the onset of COVID. Now, the point that I want to stress here is that businesses, both large and small, can trade with deficient quick ratios for an extremely long period of time. Now, it may be the case that the business itself is viable, but the company is suffering from a terminal shortage of working capital. In these scenarios, it is a mathematical certainty that the company will fail at some point in time unless that working capital deficiency can be bridged. It shouldn't take a director penalty notice or some other critical event for a business owner to contemplate how they should address these issues. If we look at Virgin, it was deficient by $706 million as early as 2017, but it took until 2020 before they called in the administrators. I mentioned business viability and company viability, and these are really two different things. First of all, if we think about a business and the notion of a business is actually quite an abstract concept. A business has no physical form, but it's made up of things like sales, gross margin, general administrative expenses, there's accounts receivable, accounts payable, there are capital assets and capital expenditure. Now, business viability focuses largely on the profit and loss and the cash flow of a business. Every business has cash coming in and cash going out, and how these various cash flow drivers interact often make the difference between success and failure. A business and business owner that's able to identify these factors can harness these powerful tools to make sure that businesses grow and that cash inflows always exceed cash outflows. A company, however, it exists. Now, it only exists on paper or within our computers, but as we know, it's a legal entity. It can sue, it can be sued, it can hold assets, it can incur liabilities. Business viability is a deeper dive into the balance sheet of a company and consideration of how the assets can be used to discharge liabilities. Where the assets can discharge liabilities, we call that recapitalisation. There are really just a few levers that a company can pull to be able to recapitalise, and they're things such as the sale of non-performing assets, convert the equity to cash, pay down the current debts, director loans or share capital. It could be term loans from banks and financiers, or it's payment plans using the future free cash flow of the business to amortise legacy liabilities. We have successfully helped many companies recapitalise where the company and the personal asset pool of directors exceed the value of the liabilities. Those pesky Div 7A loans, they come up continually, and in circumstances where the equity in personal assets exceed the working capital deficiency and the business passes a viability test, a recapitalisation strategy works extremely well. However, where recapitalisation is not practically achievable, but the business is viable, then the business owners really need to consider and assess the restructure options, just as Virgin Australia did.
And to the audience, this is just such a strong point. The distinction between business viability and current or company viability is so important in this marketplace that we're in.
Yeah, during COVID, the government policy settings were set just to keep the doors of business open. So long as people remained employed and businesses were trading, nobody was really looking. The question of company viability wasn't being asked. However, that is all changing. If we think about the assessment that needs to be made in this DPN environment, where there are tax arrears and the company is only viable if it can pay all of those arrears and all of the future liabilities when they fall due. Now that cash, it's only going to come from one of those 4 or 5 examples that I gave earlier. If a company goes onto a payment plan, but they can't make their next BAS payment in full, then they're going to default their existing agreement. We've seen this scenario come unstuck many times where a forecast suggested that a payment plan could be fulfilled, However, those forecasts are often based on a perfect scenario playing out, only to have some sort of a hiccup occur and a payment plan defaults. Now, if directors allow a director penalty notice to expire, they really are betting their personal assets on the company's ability to recapitalise. The outcome of a company viability assessment, it can only fall into one of four categories. The first one being that the business is viable and the company can be recapitalised by the directors, the shareholders, and the assets. Or the business is viable, but the company itself cannot be recapitalised. Or it might be the case that the business is not viable, but the company can be recapitalised. Even if the market has changed, the business not viable doesn't mean the liabilities can't be paid. Or indeed, a business may not be viable and the company itself also may not be viable. Now, we've got solutions for all of those scenarios, being to either restructure, recapitalise, or to look towards a controlled business exit. The conclusion that this company viability assessment allows the business owner to form is a very powerful tool. Once thoroughly worked through and properly considered, a director really should have the conviction to pursue a particular course of action with purpose and solid foundations and fundamentals.
Now, if ever there was a need for a director to make a decision and act sooner rather than later, it's probably going to be when they receive a DPN. Michael, you often have comments about the director penalty system and the fact that it is misunderstood in a number of areas. So let's talk to the audience about that point.
Yeah, thanks, Ben. There's plenty to talk about here. My observation over the years has been that there are persistent and common misconceptions about how the director penalty regime actually works. I often hear commentary such as a director penalty notice makes the director personally liable for the company debt. That's actually incorrect. Company directors are personally liable for the GST, PAYG and superannuation. They're the three common liabilities that are tied up with director penalties, and they're personally liable in parallel with the company the day that that debt gets incurred. In the ordinary course, the company pays the parallel liability or pays the debt and the parallel liability is remitted. However, when those debts continue to accrue, so does that parallel liability. What the director penalty notice actually does is it enlivens the right of the ATO to recover that debt from the director personally. I've also heard that negotiating a payment plan remits a DPN. This is also false. A DPN can only be remitted through payment of the underlying liability or for one of the three insolvency-based options. Where I think the confusion comes from here is that the ATO typically do not enforce a DPN when a payment plan is being complied with. The issue here, though, is that payments made by the company under a payment plan tend to come off the oldest debt first. Now, depending on when certain debts were incurred, those payments may not be discharging the parallel liability at all. We also see company directors who are quite often used to all ATO correspondence being dealt with by their accountant. However, director penalties, they're a personal issue, and the ATO will send these notices to the residential address of the director that is recorded with ASIC. Now, this creates a lot of issues for the director. Firstly, in this era of digital communication, most people don't check their mail regularly. Secondly, the ASIC addresses seem to be wrong more often than people would ever care to admit. So often people move house and they never get their accountant to update those ASIC addresses. If a director penalty notice is missed and it expires, it's ultimately the director's problem. It's not the ATO's. However, having said all of that, it's not all bad news. Something we have come to see this time around is that the DPN does actually pop up and appear under the Communications tab in the tax portal of the director personally. Now, this has been really helpful in a number of cases as the DPN has actually been picked up on the day before it was actually issued. This has given the director between 5 to 8 days head start in their decision-making process as compared to trying to pick up such a notice via the mail when it eventually arrives through the letterbox. Now, for directors, they really don't need to wait until a DPN is received to remit that personal liability. Ben, I know you've had a number of clients that have received 21-day director penalty notices, and you've worked with those directors and used the small business restructuring process to remit the personal director liability and restructure the balance sheet at the same time.
We certainly have. Up on the screen now, this is a slide that we actually used at a breakfast presentation back in March 2021. Very, very happy to report that we have most certainly test driven this process, and it's great. It is a perfect fit for small businesses that would be viable, but for their inability to repay debts that have accumulated on the balance sheet, such as tax arrears in the recent difficult trading environments. So what we're talking about is the company viability is in question. Now, if we move to some statistics, out of 2.35 million small businesses, only 199 companies have used this process since January 2021. So to me, that says that this process is still probably a bit of a secret for those company directors out there that do have company viability issues or deficient quick ratios. Interestingly, only 15 proposals have failed so far. So statistically, it looks like it's very good odds. Good odds, but by no means good luck. It is very important to set these up so that the proposal has the best chance of success possible. I've also found it interesting that when we look at the 15 proposals that were not accepted, only 4 of those companies did not appoint a liquidator subsequently. This tells me that directors are considering trade-on options after possibly remitting DPN liability through this process. Just a little bit about this process. So this isn't a full lesson. This is just my view on the key points. So first and foremost, it's a debtor in possession model, and that works really well. So the director controls the bank accounts. The director runs the day-to-day activities. It is business as usual. So there is no need to assign leases and sell assets and move staff, such as what would need to take place in other restructuring options. There are some qualifying criteria. The main ones being that there needs to be less than $1 million worth of debts. Lodgements need to be up to date. Super needs to be up to date. And employee entitlements need to be provisioned for. This process does remit DPN liability, so big tick there. And also, if it's not successful, so that is that creditors do not accept the plan that's put forward, then it's up to the director to decide on plan B. So what I mean by that is the company does not automatically go into some other formal insolvency appointment. This is a very, very big difference from the VA DOCA system where if creditors reject a proposal, the company automatically moves into liquidation. So from the perspective that the small business restructuring process remits DPN liability, and if the offer is not accepted, it's back to the director, business as usual. I would say that this is a very low risk process for many company directors that have company viability issues. Up on the screen now is a cut and paste from a job, which is a scenario I'm about to talk about shortly. And I think just these 2 little bits of formal correspondence say so much. So firstly, this particular company had $382,000 worth of tax debt. It made an offer to creditors at 12.25 cents in the dollar. The creditor was the ATO. The offer was accepted, and that $382,000 was settled with a $46,000 distribution. Now, it gets even more exciting in the next box down. This process started on the 2nd of June 2022, and it was all done and dusted by the 4th of July 2022. That is a very efficient process, and most certainly in this case, much more successful than trying to negotiate a payment plan that would not have been a good fit for this company given its circumstances. If we move on to the next slide and just a little bit more about the scenario I just mentioned. This business was a QBCC licensed contractor. as I mentioned, about $382,000 worth of tax debt. At the time the small business restructuring practitioner was appointed, there was no other creditors. This director had not received a DPN. They were proactive and had decided to address those liability issues well before a DPN was going to be issued. The offer that they put forward was 12 cents in the dollar, and as mentioned, the time frame was 32 days. And yes, the tax office did approve this plan. There is always pre-appointment strategy needed in any files that Michael and I work on. This particular director or company had two issues that I'll just mention. One was there was an unsecured bank overdraft for $130,000, and there was also an asset holding entity that owed back $165,000. So two things that we needed to take into account. I also mentioned that this entity was a QBCC licensed entity. So whilst no formal policy exists, what we can report to you is that the QBCC have been quite supportive of this process. What we do understand is that their current position is if subcontractors are paid and there are no home warranty insurance claims, then their focus will be on the MFR or minimum financial requirements, which the SBRP process, of course, goes a long way to improving what the balance sheet looks like. So in this particular circumstance, post restructure, this client still has a QBCC license and it is business as usual. So what a fantastic result. If we go to scenario 2, this particular director that we met with, different set of circumstances. What our advice was they were better to do a restructure by way of business sale and liquidation and not the SBRP process. The tax debt in this scenario was $584,000. There was $79,000 of other trade creditors. And again, there's always some sort of pre-appointment strategy that we need to consider. In this case, there was an electrical contracting license that needed to be applied for in a new entity, and there was a Queensland housing contract that also needed to be assigned to a new entity. That was key because that was a major source of business or workflow for this business. Now, the director, whilst they were working through what they needed to, actually received a director penalty notice. And this director was not in a position to appoint a liquidator within the 21-day timeframe. And that was because they were still waiting on the assignment of this Queensland housing contract. And again, this was integral to the viability of the business. So this then made the SBRP or small business restructuring process a really good option in the circumstances. So it was one of the 3 insolvency appointments that would remit the DPN liability. So that was a tick. And it was also a process where we could keep trading in the same entity and in this case, keep servicing the Queensland housing contract. It also was a very low risk course of action for the director to take because their upside was that they were going to remit their director penalty liability, and if the offer was not accepted by creditors, then it was still business as usual. The SBRP would resign and the director could then decide on what was going to be the plan B for this company. The offer that was put to creditors was 4 cents in the dollar, and we knew that this was very, very low, but it did represent the value that the company would receive in the event of the planned restructure. Now, the time frame that this took was 49 days, and this offer was not accepted by the ATO. The ATO did give some feedback, and interestingly, they thought that the 4 cent offer was something that could be considered, but in this case, they felt that the company was in dire straits well before COVID and that the director engagement with the ATO had been poor. And that assessment was accurate. For the offer to be accepted, the ATO's position was that the offer needed to be higher. Now, some other things that we have learnt along the way is that the return to creditors, in our view, should be somewhere between 10 and 30 cents in the dollar. And this is really also after taking into account what is the expected return in liquidation, because we want that offer to be higher than the return in liquidation. In most of the jobs that we've worked on, the ATO has been the deciding creditor, so that is representing greater than 50% in dollar value of the creditor pool. And we are very aware that the ATO is looking at compliance history, is looking at past conduct, and is interested to know how the director has communicated with them in the past. What they do want to see is that the business will be viable moving forward. Staff will be able to maintain their jobs, that suppliers will continue to supply, and that the business will be able to keep its current debts current and stay on top of things as they move forward. The ATO also, on a few jobs, has really wanted to see that there has been adequate provision made for tax obligations moving forward, and also that there's a system to support that, such as a separate bank account for GST and PAYG, and possibly the engagement of an accountant to be involved more regularly with their ongoing reporting and assessment of their trading performance. Now, to round up, the SBRP process is an awesome tool. But of course, it's only one of the three formal insolvency options that can be used as part of a turnaround plan. The other two options are a pre-position sale and liquidation and the deed of company arrangement.
Yeah, these two case studies are quite fantastic. They are examples of the common scenario where a business is spinning its wheels, churning debt without really getting ahead. If we look at the outcomes here, these businesses can now trade on positively. They can employ, they can pay their liabilities, including their future tax obligations, and the directors don't need to keep looking over their shoulder. If these directors hadn't acted, then the natural progression would be for statutory demands to be issued and winding up proceedings to commence. This would have been a totally different story for these directors. They would ultimately potentially risk losing their personal assets and going bankrupt, as well as losing the businesses. Staff would lose their jobs, creditors would get less. On the screen now are the quick ratio and the working capital calculations of those two companies. Now, interestingly here in case study 1, the quick ratio isn't a whole lot different to that of Virgin Australia. The ATO, they supported that proposal. In case study number 2, the numbers aren't particularly flattering, but they are genuine and they do highlight just how long the warning signs existed before any action was taken. Now, the good thing here is that these directors did act. Equally, though, if we look at these numbers back in 2020, it would be fair to say that these issues could have been addressed a couple of years ago also. Ladies and gentlemen, that does bring us to the conclusion of this presentation. If you've stuck with us all the way through this recording, we really do thank you. On behalf of Ben and myself and the team here at Regroup Solutions, thank you for your time. And if you do have any scenarios that you would like to workshop with us, we'll be more than keen to discuss that with you.
Thank you.